Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know. First, UK Chancellor's tax U-turn creates a £20 billion fiscal hole, risking a stealth tax and market credibility crisis. We'll analyse why this policy chaos complicates the Bank of England's inflation fight and how it could affect the British pound's trajectory. Second, the Fed invites Wall Street's primary dealers to use its emergency cash window, signalling a preemptive strike against market stress. In this episode, we'll break down this move to fight stigma around emergency borrowing and what it signals for the end of quantitative tightening. Third Fed December rate cut odds collapse from 94% to below 50%, triggering an 800-point Dow plunge and punishing AI stocks. So we'll discuss why this violent repricing is creating a credibility gap for the Fed and what it means for the sputtering AI trade. The story begins with a decision that caught everyone by surprise. The UK government just executed a stunning reversal on a major tax hike, sending shockwaves through Westminster. A while back, we flagged that UK consumers were already wobbling, saving more and spending less, and that the Bank of England was walking a tightrope. Keep that backdrop in mind because it makes today's U-turn even more consequential. Just weeks after Chancellor Rachel Reeves signalled she would break a core election promise by raising income tax rates, she has abruptly backed off. The reason? Better than expected economic forecasts. This optimism, however, hinges on forecasts from the UK's Office for Budget Responsibility, or OBR. An important detail here is that the OBR has a history of being a bit too optimistic, having overestimated UK economic growth by an average of 0.7 percentage points over a 5-year horizon since 2010. As we discussed a while back, the Bank of England only just held rates on a tight vote, caught between sticky inflation and a fragile economy. The timing is crucial because if these new rosier forecasts for wage growth and tax receipts fail to materialise, the government could face a renewed fiscal crisis. That would force emergency tax hikes or spending cuts after the election and create serious volatility in the UK, government bond market potentially pushing the BOE toward cuts even if inflation sits above target. But for now, the government is still staring down a massive £20 billion hole in its public finances. So how will they fill it? Instead of raising rates, the Treasury is now exploring other options, like freezing the salary levels where people start paying tax. Continuing our last discussion about consumer strain, this choice matters for demand. Households have already turned cautious, with the UK household saving ratio up at 10.7%, well above its pre-pandemic average. Layering a threshold freeze on top of that could squeeze spending further just as growth is fragile. This move is a classic example of what's known as a stealth tax. You see, even if the government doesn't raise the tax rate, when they freeze the tax thresholds while wages are rising with inflation, people get dragged into higher tax brackets. You know, your paycheck might get bigger, but a larger portion of it is taken by taxes, meaning your real disposable income, what you can actually spend, gets smaller. This disproportionately hurts low and middle income earners. And remember, we previously highlighted the bank's own forecast showing UK growth slowing to around 1.2% next year and unemployment drifting toward 5% for several years, exactly the kind of backdrop where a stealth squeeze debates hardest. This is where the situation takes a more complex turn. The move directly contradicts the Chancellor's own words from last year's budget when she told Parliament, "I've come to the conclusion that extending the threshold freeze would hurt working people." According to the Institute for Fiscal Studies, that freeze could raise over £8 billion a year, but it would also mean someone on minimum wage starts paying income tax for working just 18 hours a week. The apparent disarray has the opposition pouncing. And this isn't just political theatre. This perceived chaos creates a genuine financial risk. In the world of finance, this is called a political credibility gap. When a government's policies become unpredictable, investors demand a higher return to compensate for the risk. Interestingly enough, we can see this reflected in real time. The interest rate on UK 10-year government bonds, or gilts, is significantly higher than on German bonds. This gap or spread is a direct measure of the risk premium investors are placing on UK assets due to concerns over its fiscal stability. We said a while back that a sharper drop in consumer spending could deepen the downturn. If that hits tax receipts at the same time gilts demand a higher premium, the fiscal hole only gets harder to fill. Conservative leader Kemi Badenoch declared, "I have never seen this level of chaos, this level of irresponsibility. The Liberal Democrats are demanding the Chancellor come clean on what on earth is going on at the Treasury. The Chancellor was preparing the public for a painful tax hike, but now faces accusations of chaos and a difficult choice. To meet her own fiscal rules, she must still find £20 billion, forcing a decision between breaking a key promise, hurting low-income workers with a stealth tax, or making deep cuts to public spending. As we noted before the election, any big fiscal moves, tightening or loosening risk, complicating the Bowie's balancing act on inflation and growth. When we place the UK's focus on fiscal consolidation that is tightening its belt alongside what's happening elsewhere, the contrast is stark. The US is pursuing fiscal expansion ahead of its election, while the EU and China are using more targeted stimulus. We also contrasted the UK's cautious consumer with surprisingly robust US spending, and that divergence may widen. This divergence could impact relative economic growth and currency performance, particularly the British pound versus the US dollar and euro. For Chinese investors and businesses, a weaker pound could make UK goods and assets cheaper, but it also signals underlying economic strain. So what's next? The key thing to watch will be the actual UK wage growth and inflation data. A few days ago, we emphasised those prints as the main driver of the Bowie's next move, and that holds now. Add to that the path of unemployment toward 5%, which would reinforce the growth risks we flagged earlier. If they fall short of the OBR's optimistic forecast, the fiscal hole will reappear, putting pressure back on the government. Also, keep an eye on UK gilt yields. If they continue to rise relative to others, it's a sign that the market remains nervous about the UK's political and fiscal credibility and that the consumer squeeze we warned about could intensify. While the UK is wrestling with a self-inflicted credibility gap, financial authorities in the US are taking preemptive steps to avoid one. The New York Federal Reserve just pulled Wall Street's most powerful banks into a meeting about a critical financial backstop. This wasn't a public press conference. New York Fed President John Williams met with representatives from the 25 primary dealers, the very institutions that underwrite the US government's debt. So the thing is, these primary dealers are under immense pressure. The US government is issuing a record amount of new debt, and these dealers are required to absorb it. At the heart of the issue is their balance sheet capacity. If they don't have enough room on their books to hold and trade these bonds, it can lead to messy government auctions, which forces the government to pay higher interest rates. The knock-on effect is that it increases volatility in what's supposed to be the world's safest asset, US Treasury bonds, and raises borrowing costs for everyone. The topic was the standing repo facility. Think of it as the financial system's ultimate emergency cash window, where banks can swap securities like Treasury bonds for cash if liquidity suddenly dries up. This meeting shows the Fed has learnt a hard lesson. Many will remember the repo market crisis in September 2019. Back then, a sudden cash shortage caused overnight lending rates to spike from around 2% to as high as 10%. The Fed was caught off guard and had to react by pumping billions of dollars into the system. This shows they are now trying to get ahead of the problem. And that really gets to the heart of this story. The meeting happened amid what sources call brewing concerns about stress in parts of the US financial system and growing signs of tightening market liquidity. The Fed isn't waiting for a crisis. It's proactively checking the plumbing of the entire market right now. However, if you zoom out, you'll see another layer of strategy at play. A top Fed official who manages its massive bond portfolio, Roberto Perli, went on the record with a crucial message for these banks. He stated that the emergency facility should be used whenever it is economically sensible to do so. This is not a warning, it is an open invitation. This is a direct attempt to solve the long-standing problem of stigma. Historically, banks have been terrified to use the Fed's emergency lending windows. Doing so was seen as a sign of weakness, a signal that the bank was in trouble, which could attract unwanted regulatory attention and scare off investors. After all, a safety net that no one is willing to use is useless. By publicly encouraging its use, the Fed is trying to normalize it, to tell Wall Street that tapping this facility is just smart business, not a cry for help. It's the central bank telling Wall Street not to hesitate, not to fear the stigma of pulling the emergency lever if they see smoke. The New York Fed's own spokesperson confirmed the meeting's purpose was to get feedback to ensure the facility remains effective for rate control. In other words, they are making absolutely sure the safety net will actually hold if the market starts to wobble. This is also a global issue. a liquidity squeeze in the US. Doesn't just stay in the US. For our listeners in China, it's important to know that China is one of the largest foreign holders of US Treasury debt. If the US market becomes illiquid, it could prompt large foreign holders to sell their bonds to get US dollars, creating a vicious cycle. This is why the Fed has a separate tool, the FEMA repo facility, specifically for foreign central banks to prevent a global dollar funding crisis from spiraling out of control. This isn't just a technical discussion. It is a direct and calculated move by the Federal Reserve. By engaging the biggest players and publicly encouraging the use of its emergency lending tool, the Fed is signaling that it sees potential instability on the horizon and is taking clear, preemptive steps to fortify the system. So what does this all point to? This heightened focus on the SRF could be a major signal that the Fed is preparing for the end of quantitative tightening, or QT. QT is the process of the Fed shrinking its balance sheet, which pulls money out of the financial system. Ending QT would be a major policy shift. It would mean the Fed stops withdrawing liquidity, which would be a positive for markets. An earlier than expected end to QT could lead to lower bond yields, a boost for risk assets like stocks, and potentially a weaker US dollar. The key indicator to watch will be the usage of the SRF itself. If we see banks start to use it more frequently, especially around quarter end or tax deadlines, it will confirm that liquidity is tight and that the end of QT might be approaching sooner rather than later. We were just talking about the Fed's efforts to keep the financial plumbing stable, but that hasn't stopped a major shock from rattling the markets. Just 1 month ago, a December rate cut from the Federal Reserve was seen as a 94% certainty. Today, that bet has completely collapsed, with traders now pricing the odds at less than 50%. A while back, we flagged how those odds, then north of 95%, can flip fast when guidance loses credibility. This is one of those moments. Now, this probability isn't just a wild guess. It's derived from the CME FedWatch tool, which analyzes real-time trading in federal funds futures contracts. As we've discussed before, when the market's expectations shift this violently and diverge from the Fed's own signals, it creates a sharp disconnect. The crux of the problem is that this divergence significantly increases market volatility and raises the risk of a policy error where the Fed either tightens or eases at the wrong time, potentially harming the economy. We also noted a while back that a hawkish faction inside the Fed has been raising the bar for more easing. That credibility gap is exactly what markets are wrestling with now. For now, this means we can likely expect the US dollar to remain strong while pressure continues on both stocks and bonds. Wall Street is a sea of red. The Dow plunged nearly 800 points, and the Nasdaq Composite is staring down its third straight losing session, fueled by a sputtering AI trade. The pain is specific and deep. Disney shares tumbled more than 7% after reporting weaker than expected revenue, and it gets worse for big tech. Oracle is currently on pace for its worst quarter since 2002 as Wall Street loses faith in its AI ambitions. A while back, we highlighted how concentration in AI-linked megacaps could turn a routine wobble into a broader sell-off. Today's tape looks like a textbook case of that vulnerability. Believe it or not, the market's logic seems to be shifting right before our eyes. It seems investors are moving from a phase of rewarding any company for spending on AI to now demanding a proven return on that investment. The punishment of Oracle suggests a pivotal shift. The market is now looking for real profits from AI, not just ambitious plans. As we discussed in our earlier breakdown of Oracle's AI profitability mirage, the issue isn't AI per se, it's whether the economics pencil out, especially for debt-fueled build-outs with thinner margins than legacy software. But while traders are punishing AI stocks, a top voice at JP Morgan is calling the very idea of an AI bubble a crazy concept. This creates a massive disconnect between market action and big bank conviction. Who is right? In reality, both might have a point, but the market's fear is rooted in a very real emerging risk. What really brought this to a head was the next development. The incredible speed of technological advancement itself is becoming a financial liability. For example, NVIDIA's newest Blackwell GPUs, which just launched, are already set to be succeeded by the even more powerful Rubin architecture in 2026. This is causing the depreciation cycle for these critical chips to shrink from the traditional 4 years to possibly just 2. As we warned a while back, if useful lives get marked down, reported profits can vanish in sudden write-downs. Another reason software moats may outlast hardware arms races. This rapid obsolescence could destroy the profitability of multi-billion-dollar data center investments, favoring companies with superior software over those with just massive hardware scale. The warning signs are now flashing beyond the trading floor. New data shows foreclosure starts have jumped 20% from a year ago, signaling potential cracks in the housing market. This is a significant data point because foreclosure starts are considered a leading economic indicator. They represent the very beginning of the legal repossession process. So a 20% jump is an early warning that household financial health is more fragile than many believed. This trend, if it continues, poses a significant downside risk to the upcoming holiday retail sales and could put downward pressure on economic growth in the first quarter of the new year. At the same time, reports show high-income shoppers are hunting for deals and younger consumers are tightening their purse strings, casting a shadow over the upcoming holiday retail season. Amid the market turmoil and economic jitters, one of the most powerful statements came from Coatue management founder Philippe Lafont, who delivered a stunning verdict on a cornerstone of capitalism. He declared the initial public offering market is completely broken and beyond repair. Lafont's statement is so jarring because a broken IPO market has profound consequences. When late-stage tech startups can't go public, they are often forced to seek exits through mergers and acquisitions. This could lead to a wave of industry consolidation where larger companies buy up innovative, smaller ones. For international observers, especially in China, this is a key trend to watch. It may create acquisition opportunities for foreign buyers, but it could also trigger much stricter scrutiny from the Committee on Foreign Investment in the United States, or CFIUS, especially over deals involving critical technology transfers.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.